$30 to $84 trillion is about to move hands in what's being called the biggest wealth transfer in history. Baby boomers are dying. Their wealth is being transferred to their children and grandchildren. But here's what nobody's talking about. 90% of inherited wealth is going to people who already have wealth. The bottom 50% of Americans will receive less than 1% of the total wealth transfer. Meanwhile, financial advisors, estate lawyers, and tax professionals are preparing their clients for this transfer. Most ordinary people have no idea it's happening and are completely unprepared. This transfer is accelerating wealth concentration, widening inequality, and creating a permanent wealth underclass. The baby boomer generation, born between 1946 and 1964, is the wealthiest generation in American history. They accumulated roughly 70% of all U.S. wealth through decades of favorable economic conditions, stable employment, cheap real estate, defined benefit pensions, and favorable tax treatment. They're now reaching the end of their lives. As they pass, their accumulated wealth is being transferred to their heirs. The scale is incomprehensible. $84 trillion would be enough to pay off the entire federal deficit multiple times over. It's wealth that took an entire generation to accumulate, concentrated in the hands of a relatively small percentage of people, and now being transferred. This transfer is reshaping wealth distribution, creating opportunities for some, and leaving others further behind. By the end of this video, you'll understand exactly how much wealth is being transferred, who's inheriting it, why the wealth is concentrating in fewer hands, what the implications are for inequality, and most importantly, whether you're positioned to benefit from this wealth transfer or whether you're about to be left further behind. Before we go further, if you want to actually understand what's happening with intergenerational wealth and how the wealthiest people are positioning themselves for this historic transfer, this is exactly what this channel breaks down every week. Subscribe now, because what I'm about to show you next is how the wealth transfer is accelerating inequality and creating permanent wealth tiers in America. Let's start with the scale of the wealth transfer, because understanding the magnitude is crucial. The total U.S. wealth held by baby boomers is estimated at roughly $30 to $84 trillion, depending on which estimate you use and what time period you're looking at. To put this in context, the entire U.S. gross domestic product is roughly $35 trillion annually. The wealth of baby boomers alone is roughly 2 to 2.4 years of entire U.S. economic output, accumulated by one generation over their lifetimes. This wealth is held in multiple forms: real estate, stock portfolios, retirement accounts, business interests, and cash. As baby boomers pass away, this wealth is transferred to their heirs through inheritance, trusts, and estate distributions. The transfer isn't happening all at once. It's happening gradually over decades. The peak transfer is estimated to occur between 2030 and 2050, but the process has already begun. Some estimates suggest that by 2050, roughly $54 trillion will have been transferred to the next generation. By 2080, the transfer could exceed $84 trillion. This is wealth that will reshape family finances, fund education, purchase homes, start businesses, and accumulate further in investment accounts. But here's the crucial detail: this wealth transfer is not evenly distributed. It's concentrated among the wealthiest families. The top 10% of baby boomers hold roughly 70% of all baby boomer wealth. When they transfer their wealth to their heirs, that wealth goes to the heirs of the wealthy, not to ordinary people. This means the wealth transfer is accelerating wealth concentration, not distributing wealth more evenly. And now let's talk about who's actually inheriting this wealth, because understanding the distribution reveals the inequality mechanism. The top 10% of baby boomers have an average net worth of roughly $5 million. When they pass, their wealth goes to their children, who are typically already wealthy or high-income earners themselves. These heirs inherit investment portfolios, real estate holdings, business interests, and accumulated cash. By contrast, the median baby boomer net worth is roughly $180,000. Much of this wealth is concentrated in a primary residence. When these baby boomers pass, their heirs inherit a home, possibly some savings, and possibly some retirement account balances. The wealth is real, but it's a fraction of what the wealthy are transferring. The bottom 50% of baby boomers have essentially no net worth to transfer. They have some savings, perhaps a primary residence with significant mortgage debt, and retirement account balances that might be depleted by healthcare costs before death. When they pass, there's often more debt than assets to transfer. Their heirs inherit nothing or negative net worth. The result is that 90% of inherited wealth is going to people in the top wealth tiers. These people already have wealth. They already have investment portfolios. They already own multiple properties. They already have professional advisors managing their finance. The wealth transfer doesn't create new wealthy people. It concentrates wealth among people who are already wealthy. Meanwhile, ordinary people and lower-income people receive almost nothing from the wealth transfer. They're excluded entirely. The mechanism is brutal in its simplicity. The wealthy accumulate wealth across their lifetimes, transfer that wealth to their heirs, the heirs accumulate more wealth, and the cycle repeats. Ordinary people accumulate little wealth in their lifetimes, have little to transfer to heirs, and the cycle repeats for them too, but at a much lower wealth level. Let's talk about the tax implications of this wealth transfer, because understanding the tax landscape landscape reveals how wealth avoidance works. Currently, the federal estate tax only applies to estates larger than roughly $13.61 million for individuals and roughly $27.2 million for married couples. For most ordinary people, there's no federal estate tax. Their heirs inherit assets without triggering federal taxation. But here's the crucial detail: assets inherited receive a stepped-up cost basis. This means if your parents bought a house for $100,000 and it's worth $1 million when they die, your cost basis for tax purposes is $1 million, not $100,000. If you sell immediately, you owe no capital gains tax. The gain that occurred during your parents' lifetime is completely erased for tax purposes. This is an enormous tax benefit for wealthy people. A wealthy real estate investor who accumulated $5 million in property appreciation over their lifetime can pass that wealth to their heirs completely tax-free through the stepped-up basis mechanism. The heirs inherit properties worth $5 million without owing any capital gains tax on the appreciation. Wealthy families structure their estates specifically to exploit this mechanism. They hold real estate, business interests, and investment portfolios in trust designed to minimize tax obligations at death and transfer. They work with estate planners, tax attorneys, and CPAs to structure their wealth transfer in ways that preserve as much wealth as possible for heirs. Ordinary people don't have access to these advisors. They don't structure their estates. They don't have trusts. They don't have tax planning strategies. Their heirs inherit whatever wealth they accumulated, pay any applicable taxes, and the net transfer is smaller. The difference in after-tax wealth transferred is enormous. Now let's talk about who's profiting from the wealth transfer, because understanding the beneficiaries reveals the economic incentive structure. Estate planning attorneys are profiting. Creating trusts, wills, and estate plans for wealthy people is highly profitable business. A family with $5 million in assets might pay $50,000 to $100,000 for comprehensive estate planning. Multiply that across thousands of wealthy families going through the wealth transfer process, and the fees add up to billions. Tax professionals are profiting. Accountants and tax advisors who specialize in tax-efficient wealth transfer strategies are in high demand. Wealthy families are willing to pay substantial fees to minimize tax obligations on inherited wealth. A tax strategy that saves $200,000 in taxes is worth paying $20,000 in advisory fees. Financial advisors are profiting. Managing inherited wealth is highly profitable for advisors. A $2 million inheritance provides ongoing fees for investment management, financial planning, and wealth management services. Advisors compete aggressively for inherited wealth clients because inheritance is a major trigger for account consolidation and wealth management engagement. Investment firms are profiting. Merrill Lynch, Goldman Sachs, JP Morgan, and other major wealth management firms are hiring aggressively to handle inherited wealth. They're targeting heirs of baby boomers specifically, trying to capture the wealth transfer as it occurs. Real estate professionals are profiting. Estate sales, trust property liquidations, and inherited property sales generate commissions. Real estate agents compete for inherited property listings because they know these are often forced sales where executors want to quickly liquidate assets. The entire wealth management industry is structured around the wealth transfer. Marketing campaigns target people receiving inheritances. Financial advisors specifically train their teams on talking to heirs about inherited wealth. The industry has recognized that the wealth transfer is a massive opportunity and is positioning itself to capture as much of that opportunity as possible. Ordinary people are not profiting. They're not getting wealthy from the transfer. They're not accessing these services. They're being left behind by the wealth transfer process. Let's talk about the inequality implications of this wealth transfer, because understanding the mechanism explains how inequality is accelerating. Wealth concentration happens through inheritance. A wealthy family with $10 million passes $5 million to each of two children. Each child now has $5 million inherited, plus whatever they earned themselves during their working years. If each child earned $2 million through their careers, each now has $7 million. They invest this aggressively and it grows to $10 million by retirement. They then pass $5 million each to their children, who now start with $5 million inherited, earn $2 million through their careers, end with $7 million, and the cycle continues with each generation starting wealthier than the previous generation. By contrast, an ordinary family with $200,000 in net worth passes $100,000 to each of two children. Each child starts with $100,000 inherited, works, earns perhaps $1 million over their career, and ends with $1.1 million. They pass $550,000 each to their children, who start wealthier than their parents but still ordinary. Each generation starting at a higher point than the previous, but the wealth trajectory is completely different from the wealthy family. After 10 generations, the wealthy family has accumulated vastly more wealth through compounding and inheritance stacking. The ordinary family has accumulated linear wealth through work. The gap widens exponentially. This is the mechanism through which inequality accelerates across generations. The wealth transfer is happening right now with baby boomer assets. The richest 1% of baby boomers are transferring their wealth to their heirs. Those heirs are starting their wealth building journey with $10 million instead of zero. The richest 10% are transferring wealth. Those heirs start with $1 million. The The top 50% are transferring meaningful wealth. Those heirs start with several $100,000. The bottom 50% are transferring almost nothing. Their heirs start from near zero. The result is that inequality is increasing through inheritance. The wealthy are using the wealth transfer mechanism to accelerate their own inequality advantage. Now let's talk about the real estate dimension of the wealth transfer, because real estate is where much of the wealth is concentrated. Baby boomers own substantial real estate holdings. Many own primary residences purchased decades ago that have appreciated dramatically. Some own rental properties or investment real estate. Some own vacation properties. Real estate represents a significant portion of the 30 to 84 trillion in baby boomer wealth. As baby boomers die, this real estate is inherited by their heirs. The heirs receive property with a stepped-up cost basis, meaning if the property was worth $500,000 when purchased and $1.5 million when inherited, the cost basis is $1.5 million. If the heirs sell immediately, no capital gains tax is owed. This creates opportunities for wealthy heirs to acquire real estate portfolios at essentially tax-free transfers. A wealthy heir might inherit 5 properties worth $2 million each, immediately sell them, net the full $10 million without capital gains tax, and redeploy that capital into new investments. Institutional investors are watching this process closely. They're positioned to purchase inherited properties from heirs who don't want to manage real estate. They're offering attractive cash purchases of inherited properties, allowing heirs to quickly liquidate and redeploy capital into stocks or other investments. Real estate values are being affected by this transfer. In areas with high concentrations of wealthy baby boomers, inherited property sales are increasing supply. In some markets, this is pushing prices down slightly. In others, wealthy heirs are consolidating ownership, removing properties from the market, and driving prices up. The net effect is that real estate wealth accumulated by baby boomers is being consolidated into the hands of heirs, often wealthy heirs who use it as part of diversified portfolios rather than owner-occupied residences. Let's talk about how baby boomers accumulated their wealth, because understanding the source explains why the transfer is so concentrated. Baby boomers benefited from exceptionally favorable economic conditions. They entered the workforce in the 1960s and 1970s when economic growth was strong, inflation was moderate, and employment was secure. They had access to defined benefit pensions, which are now mostly extinct. They bought homes in the 1970s and 80s when housing was affordable relative to incomes. Those homes appreciated dramatically over decades as housing prices climbed. They had access to cheap stock market returns during the 1980s and 90s when the stock market generated outsized returns. They benefited from favorable tax treatment of capital gains and investment income. They had stable careers at large corporations that offered benefits and retirement plans. By contrast, younger generations entered the workforce in the 2000s when housing was expensive, pensions had been eliminated in favor of 401ks, stock market returns were mediocre, and job stability was declining. Gen X and millennials are earning similar or higher nominal incomes than baby boomers did, but after accounting for housing costs, healthcare costs, education costs, and inflation, they have far less purchasing power and accumulation capacity. The result is that baby boomers accumulated wealth in part through their own efforts, but also through exceptional economic conditions and favorable policy. They're not transferring wealth earned entirely through their own work. They're transferring wealth accumulated through decades of favorable conditions that no longer exist. Younger generations are facing exactly opposite conditions. Housing is unaffordable. Pensions don't exist. Stock market returns are lower. Inflation is eating into purchasing power. Job stability is declining. They're accumulating wealth far more slowly, if at all. When they pass wealth to their heirs, it will be a fraction of what baby boomers accumulated, unless they somehow access the wealth transfer now happening and invest it aggressively. And now let's talk about what ordinary people can do if they're inheriting wealth from baby boomer relatives, because there are specific strategies that can make a difference. First, understand the stepped-up cost basis benefit. If you inherit real estate or investment property, your cost basis is the fair market value at the date of death. This means if your parent purchased a property for $100,000 and it's worth $1 million at death, your cost basis is $1 million. If you sell, you owe no capital gains tax on the appreciation that occurred during your parent's lifetime. This is a powerful tax benefit that you should understand and exploit if you inherit property. Second, consider whether to hold or sell inherited property. If you inherit a rental property that generates cash flow, you might want to keep it and benefit from ongoing rental income. If you inherit a property that doesn't generate income and has appreciation risk, you might want to sell and redeploy the capital into diversified investments. Third, hire an estate attorney or tax professional to help you navigate the inheritance. The cost of professional advice is small compared to the potential tax savings or missed opportunities. A professional can help you understand the implications of inherited assets, optimize tax treatment, and make strategic decisions about what to keep and what to sell. Fourth, don't rush decisions. Inheritances often come with emotional attachment and family complications. Take time to understand the assets, consult with professionals, and make deliberate decisions rather than rushed ones. Fifth, if you inherit significant wealth, strongly consider working working with a financial advisor to develop an investment strategy. Inherited wealth is a one-time opportunity to deploy capital. If you invest it wisely and let it compound, it can accumulate substantially over decades. 6. Understand that inheriting wealth from baby boomer parents is not guaranteed or universal. Most ordinary people will inherit nothing or minimal wealth. If you're positioned to inherit, recognize it as an exceptional opportunity and optimize accordingly. Let's talk about the generational impact of the wealth transfer, because understanding how it's reshaping generations helps explain future inequality. Gen X, the generation born between 1965 and 1980, is the primary beneficiary of baby boomer wealth transfer. Gen X is now in their 50s and 60s, at peak earning years and at the age where they're inheriting from baby boomer parents. Some Gen X members are inheriting substantial wealth. This allows them to retire early, invest aggressively, and accumulate additional wealth. Others are inheriting modest amounts or nothing. Millennials, born between 1981 and 1996, are now in their 30s and 40s. The oldest millennials are just beginning to inherit from baby boomer grandparents, but most won't inherit significantly until later in their careers. Millennials as a whole are behind on wealth accumulation compared to previous generations at the same age. If they inherit wealth from baby boomer parents, it could significantly accelerate their wealth trajectory. If they don't inherit, they'll fall further behind. Gen Z, born between 1997 and 2012, won't experience significant inheritance for decades. By the time Gen Z inherits from Gen X and millennials, wealth inequality will be even more pronounced. Gen Z's wealth trajectory depends on the wealth of their parents, who may or may not have benefited from baby boomer wealth transfer. The wealth transfer is creating a generational divide. Some Gen X and millennials will inherit substantially and accelerate their wealth accumulation. Others will inherit modestly or nothing and struggle to accumulate wealth. This divide will compound across generations, creating permanent wealth tiers based on family inheritance rather than individual effort. Younger generations face a brutal truth: if their parents didn't inherit from baby boomers, and if their parents didn't accumulate wealth independently, they're starting their wealth accumulation from near zero. The wealthier people their age will have inherited capital. The competition for wealth accumulation is fundamentally rigged in favor of people who inherited. Now let's talk about the investment opportunities created by the wealth transfer, because understanding where capital is flowing helps identify where opportunity exists. The wealth transfer is creating massive inflows of capital into financial markets. Inherited wealth is often consolidated into investment accounts, retirement plans, and investment portfolios. This capital flows into stocks, bonds, real estate investment trusts, and alternative investments. Asset managers and financial advisors are actively competing to capture this inherited wealth. This creates opportunities for investment firms. Companies positioned to capture inherited wealth and manage it are growing rapidly. Firms with strong brand recognition among older, wealthy investors are well positioned. Robo-advisors and apps targeting inherited wealth are emerging. The industry is recognizing that inherited wealth is a major opportunity. There are also opportunities in estate services. Appraisers, real estate agents, estate liquidators, and other service providers are seeing increased demand as inherited estates are evaluated and liquidated. Companies in these spaces are hiring aggressively. For ordinary investors, the wealth transfer creates opportunities to invest in companies positioned to benefit from it. Publicly traded wealth management firms, financial technology companies serving inherited wealth, and real estate companies positioned to buy inherited properties are all positioned to benefit from the wealth transfer. But for ordinary people trying to accumulate wealth without inherited capital, the wealth transfer creates headwinds. Capital is flowing into the hands of people who already have wealth. It's concentrating wealth, not distributing it. The investment opportunities being created are mostly for wealthy people and for companies serving wealthy people. Ordinary people are excluded from most of the wealth transfer opportunity. They're not inheriting significantly, and they're not positioned to benefit from the capital flows created by the transfer. Let's talk about the policy implications of the wealth transfer, because understanding the regulatory landscape reveals how wealth concentration is being facilitated or resisted. Current estate tax law allows substantial wealth transfer without taxation for most families. The federal estate tax exemption is roughly $13.6 million for individuals, which means families can transfer wealth up to that amount without federal estate tax. For married couples, it's roughly $27.2 million. Some policymakers argue that this exemption is too high and creates inequality. They propose lowering the exemption or increasing the estate tax rate to capture more tax revenue from wealthy estate transfers. Other policymakers argue that the estate tax is unjust because it taxes the same money twice, once when it's earned and again when it's transferred, and that it should be eliminated entirely. The stepped-up cost basis mechanism is also controversial. Some argue it's a massive tax loophole that should be eliminated. Others argue that eliminating it would create double taxation and is unfair. Currently, no meaningful estate tax reform has occurred. The exemption remains at $13.6 million. The stepped-up basis remains in place. Wealthy families continue to structure their wealth transfers to minimize tax obligations. generations. The system is working in favor of wealth concentration. Policy is unlikely to change dramatically in the near term because wealthy people have political influence and are positioned to resist wealth transfer taxation. Until policy changes, the current system will continue to facilitate wealth concentration through inheritance. For ordinary people, this means that the wealth transfer will continue to concentrate wealth among people who already have it, and policy is unlikely to intervene to distribute inherited wealth more evenly. And now let's talk about what the wealth transfer means for housing and real estate, because understanding property dynamics helps predict future market conditions. Baby boomers own substantial real estate holdings. As they pass, this real estate is inherited by Gen X and millennials. Some inheritors will want to keep the properties and benefit from ownership or rental income. Others will want to sell and redeploy capital into other investments. The aggregate effect is likely to increase real estate supply in certain markets as inherited properties are liquidated. This could suppress housing prices in areas with high concentrations of baby boomer wealth. In other areas, wealthy heirs might consolidate ownership, reducing supply and pushing prices higher. Investment firms and institutional investors are positioning themselves to purchase inherited real estate from heirs who don't want to manage properties. This could accelerate the institutional takeover of single-family real estate, further reducing affordability for ordinary buyers. Real estate agents and brokers are actively targeting inherited property sales, seeing them as high-commission opportunities. They're marketing estate liquidation services and trying to capture listings from heirs. For ordinary people trying to buy homes, the wealth transfer complicates the picture. Wealthy heirs inheriting real estate might choose to hold it as investment property, reducing housing supply. Institutional investors buying inherited properties are removing them from owner-occupied market. The net effect is likely to worsen housing affordability for ordinary buyers. The wealth transfer is not just concentrating financial wealth, it's concentrating real estate wealth, further limiting housing access and affordability for ordinary people. Let's talk about personal preparation for the wealth transfer, because understanding what you need to do helps position yourself better. If you expect to inherit wealth from baby boomer relatives, first understand the basics of the inheritance. Talk to your relatives or their financial advisors about what you might inherit. Understand whether it's real estate, investment accounts, or cash. Understand the approximate value and timing. Second, start learning about wealth management. Read about investment strategies, tax-efficient investing, and wealth preservation. The more you understand before you inherit, the better decisions you'll make after you inherit. Third, identify the professionals you'll need. Find an estate attorney, a tax professional, and a financial advisor who can help you navigate the inheritance. Interview multiple professionals and choose ones you trust. Fourth, if you don't expect to inherit significantly, focus on wealth accumulation through your own efforts. The wealth transfer is accelerating inequality for people who aren't inheriting. If you're not positioned to inherit, you need to work harder to accumulate wealth through savings and investment. Fifth, understand that the wealth transfer is not equally distributed. Most people will inherit little or nothing. If you're positioned to inherit substantially, recognize it as an exceptional opportunity and plan accordingly. 6. Consider whether you want to be a beneficiary of family wealth. Some people deliberately opt out of inheritance or donate inherited wealth to charity. If you have moral concerns about concentrating wealth, you can choose to distribute it rather than concentrate it further. The personal implications of the wealth transfer vary enormously depending on your family situation. The key is to understand whether you're positioned to benefit and to plan accordingly. If understanding how intergenerational wealth transfer is reshaping inequality and how the wealthiest people are positioning themselves for this historic transfer is useful to you, that's exactly what this channel is built around every single week. The wealth transfer is one of the most significant financial events of our time, and understanding it is crucial if you want to be positioned to benefit from it or at least understand how it's affecting your economic prospects. Subscribing means you won't miss the next breakdown of how wealth is actually concentrated, inherited, and transferred across generations, and how the system is structured to accelerate inequality rather than reduce it. More importantly, you're getting someone who's specifically focused on understanding wealth mechanisms and explaining them clearly without the financial industry's bias towards selling services to the wealthy. Before you go, drop a comment and tell me honestly, do you expect to inherit substantial wealth from baby boomer relatives? And if so, have you started thinking about how you'll manage and invest it? Or are you expecting to inherit little or nothing? And if so, what's your strategy for accumulating wealth without inherited capital? Your answer tells you a lot about whether the wealth transfer is working in your favor or against you. And just to be clear, this content is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not a licensed financial advisor, tax attorney, or investment professional. Always do your own research and consult with a qualified professional, a financial advisor, tax professional, or attorney before making any significant financial or investment decisions. Past performance is not indicative of future results. All investments carry risk, including potential loss of principal. See you in the next one.